In this week's update, the smart way to follow trends. Avoiding herd mentality pays off big time, and gold is really sprinting. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. What an extraordinary 2 weeks we've had. The first week of September down very heavily, markets around the world on what wasn't that much more than one or two data points. Then we got an amazing rebound last week, pretty much reversing almost exactly the losses of the week before. So at an index level, we're back to where we started in September. And you'd have to say the odds of the market moving higher from here to the end of the year are not too bad. I want to look at some market realities today that sometimes they get missed. People just, forget about them. We get into a routine. We get into a bit of a rut, if you like, with our investing. We sort of switch off and we just go with the flow. So I just want to highlight some market realities just as a bit of a tap on the shoulder, I guess. Rotations in the market are a given. They're happening all the time. Sometimes sectors will be in favour for a few months, sometimes for a few years, but inevitably they get overcooked because everybody just gets too enthusiastic, forgets about valuations, and they will run too far to the upside, and then they'll correct and money will flow to other sections. So it's going on all the time. And that is why your thinking and your target stocks must be flexible, and they must be very agile in the sense that you don't want to get stuck on something. You want to be able to recognize the signs and move quickly, because sometimes these rotations can be very, very significant in just a matter of a handful of days. So you definitely don't want to get caught in a mindset that things are going to remain as they are. And to avoid making emotional decisions, your decisions must be made by process, must be driven by process. And I talk about this nearly every week. It's so critically important. Yet the feedback I get from various questions, particularly from non-members, would indicate that not a lot of people are actually being driven by a process. It's just a series of unconnected decisions about what you'll buy and sell. Rotations are a wonderful opportunity for building wealth, but most people don't catch on to them until it's far too late. So there's something that you've got to be alert to and move on fairly quickly. It's very easy to fall into the trap of running with the herd and running with the herd thinking, because we feel more comfortable. And that's the danger, that when you get that feeling of being comfortable, that you're doing what everybody else is doing, you're thinking like everybody else is thinking, and of course the rotations occur and you haven't seen them because your thinking is just not going that way. So if you catch yourself out feeling very comfortable with how things are going, then you probably need to be looking even harder at what you own and what you don't own, because you won't see the obvious peaks and troughs and reversals that occur unless you've got that mindset that's always looking for changes of character. So what is it that you do? And you may not know the answer to this, but at least you can start the process. What do you do to avoid this? What do you do to avoid getting too comfortable with the market, just going along with the flow and not critically examining whether some of the stocks you own are just getting way too far ahead of themselves? And the real art of successful investing is about being able to tell the difference between the truly great companies and the vast majority, which are really just shaky pretenders, if you like. And that's the difference, because the really great companies can be held for decades and they will produce you extraordinary wealth. And I'll touch on that more on the next slide. So you don't want to get out of those stocks too readily. You really want to let them run. But you don't want to assume that all stocks that are currently market darlings are going to continue that way, because history shows that the vast majority of them end up failing and can be a very poor investment over the long term. So let's just look at a couple of examples just while I'm here. So if we look at some stocks, a couple of stocks that not only were they very successful in terms of share price increase, but they were regarded as obvious long-term successful companies. And there are many, many of these. I could show you hundreds, but just a couple just to get your mind thinking in the right way. This is A2 milk. So if we go back from the period from 2015, 2016 to the peak in 2020, the share price did extraordinarily well. It was more than a 10-bagger. And of course, everybody thought that it was just going to be a continued runway to the moon because of the demand from China. So if you weren't alert to the signals of rotation, which were pretty obvious at the time, then, this has declined from $20 and it's gone almost back to where it started 6-7 years earlier. So being able to pick the difference between what are the superstars that you should hold and what are the ones that you shouldn't, and when you should get out of them, what are the signals that would indicate you should get out of those stocks. Lend-Lease is another company that if you asked 100 brokers what was a stock that should be in everyone's portfolio, then Lend-Lease would be one of those kind of stocks. But it peaked in 2018, so in the last 6 years, we've fallen from above $20 and we're now down to about $7. It's lost 2/3 of its value. So if you'd held on with a stock like that, thinking that it was going to be a great long-term wealth compounder, then you'd be incredibly disappointed and a lot poorer for the exercise. So there are many, many of those stocks. In fact, the vast majority of so-called long-term wealth compounders are actually pretty shaky pretenders. But there are some stocks that over the long term have generated enormous wealth for people that have held. Stocks like CSL, which has been a 10-bagger in the last 15 years or so. PME, which has just done extraordinarily well and has gone from just $1 or so to $170 in around about 10 years. We've gone up by 170 odd %. So that's been an enormous success story and has created a lot of wealth for the people that had the process and the ability to hold through that time, to hold a superstar. Microsoft is another stock that's obviously done incredibly well over the decades. So these stocks exist, but they are the minority. And so the challenge is to know what are the ones that are going to go on to this, incredible success over the decades, and what is the majority that won't ever get there. And just while I'm here, let's just look at a couple of other charts. This is a stock called Intuitive Surgical. It's in America. It's the world's predominant manufacturer of surgical robotic equipment. The reason that I raise this is the benefit of being able to, first of all, understand that the fundamentals will probably drive this stock on and on higher for a long period of time, and that significant retracements can be a really wonderful opportunity to get into these sort of stocks. So if we pan back here, you can see that ISRG, I'm just using this stock as an example. It's not a particular recommendation. It's an example of the trend and the opportunity. So we've had an enormous gain in this stock over a period of, say, 5 years. We then got a significant retracement, which was for a couple of different reasons, but didn't change the long-term business case. And so that was an opportunity to get into a stock that still offers enormous long-term upside. The question is, what was the market signal that this downtrend was over and we're moving back into an uptrend? This is a weekly chart. If you stand back, you've got your list of targets ready to go, then you're just looking for the opportunity to build into these sort of stocks. So where was the change of character that occurred? We had a retracement. We then had a consolidation sideways, and that took from the middle of May to the middle of October. So we're talking 5 months. So you've got to be alert, you've got to be organized, you've got to be patient, because sometimes you've got to wait a not insignificant period of time. But eventually the market showed its hand and the stock price started to move higher. We broke out, we retested the breakout, all pretty standard stuff. And since then, it's gone on from around $250 to a current price of basically $500. So a double there in what is one of the world's great market dominators. the question, I guess, is being asked about NVIDIA at the moment. And there are lots of preconceptions about NVIDIA, whether it's a stock that's grossly overvalued. I've reviewed it a couple of times in these Sunday videos. I'd personally, given the growth on offer, I don't think it's particularly overvalued. It's not to the extreme that many stocks get to. But the question is, there are some unknowns. We don't know whether the incredible rate of the building out of data centers, which has contributed to NVIDIA's success, is that going to continue or is it not going to continue? And we don't know the answer to that. And so the fallback position is always, what is the market flow telling us about where the money is actually going? Because that's what makes us money. It's not the fact that the fundamentals are fantastic. It's that money is flowing into the stock or flowing out of the stock. That's what makes the difference. So the important thing with a stock like NVIDIA, if it is on your long-term target list, is to know what a resumption of the long-term uptrend looks like. Just as we did back here, or as we were able to back here, what does the chart need to do to show you that we've gone from downtrend through consolidation and we're now moving back into uptrend? And it's all fairly straightforward kind of technical analysis, but it unfolds sometimes over such a long period of time that it's easy to miss it. It's easy to move on to other things and just lose sight of it. But this is where some of the really great wealth building opportunities arise. All right, so the next market reality is that the bulk of your lifetime profits, and this is where I'm really going with all this, the bulk of your lifetime profits come from a very small portion of your holdings. It's just the market reality. You know, you're not going to get a nice even spread of profitable stocks. So the ones that have got the potential, the true potential, the CSLs, the PMEs, the Microsofts, they've got that absolute potential and likelihood of reaching that potential. You need to nurture and protect those very exceptional opportunities. You don't want to get out too soon. And you've got to do it while also protecting capital, because recognizing that there are going to be some of those stocks that are going to end up being failures, like A2 Milk, like Lend-Lease, etc. So that is the essence of successful investing, is to be able to balance between those two situations, the stocks that you can allow to go, and when they go through a periodic retracement, then you might trim a little off your exposure, but you basically maintain a solid exposure throughout. And of course, the most important thing is that the once great stocks, you need to be able to recognize that they're not that, and you've got to get out of them. So it's the balance between those two extremes that's the key, and it's about process. And that process requires obviously initial research, but also ongoing research, because circumstances change. They're changing all the time. There needs to be a continual refreshment, both of the position of the market and also the individual stock itself. And of course, the final thing is you need a plan to manage your weightings, because if you're in a stock like a Microsoft or a PME and you just let it sit there for 10 years, then your weighting in that stock as a proportion of your portfolio would become absolutely ginormous. So that means any small movements are going to be amplified in the value of your portfolio. So you do need to exercise some management of the weightings in your portfolio. But again, this is not difficult stuff. It just requires getting organized, being patient, and pre-thinking what entries and exits would look like. All right, hopefully that helps. It's just some key aspects of successful long-term investing. Let's turn to the market now. The S&P was up 4% for the week, and the NASDAQ almost 6%, and that was almost a carbon copy reversal of what had happened the previous week. The equal weight S&P was up 2.7%, so not quite as good. And IWM was up 4.3%, but it was very, very solid all around. Now that it appears that rate cuts are almost a given, it's just a matter now of, is it 25 basis points or is it 50 basis points? And the economy is not really going to fall in a hole. That was the second fear. So we went from the worst week of the year to the best week of the year back to back. And you don't see that very often. And it's that level of volatility which just creates an enormous amount of uncertainty in investors' minds. What should they do? Is this a market top? And I saw plenty of media narrative around that at the end of the week before last. This has got to be a market top because of this, that, and the other. Turned out it is quite probably not going to be. So it's that volatility is the reason why I bang on every week about the need for a very clearly defined plan, because it's extremely hard to negotiate that sort of volatility unless you're really clear about what you're doing. The US dollar index was lower, just over 101. The yield fell a little bit further. We're down to 3.66. And the VIX came back down from the low 20s back down to 16.5. All right, let's go and look at some charts. Just one other here before I move on. I started showing this last week. This is FXY, which is basically the Japanese yen. And it's still edging its way higher, which is quite interesting because part of the reason that the market had fallen heavily was concerns about the rising yen. The yen rose last week, but equities obviously weren't terribly concerned about that. All right, there's the S&P. So the journey of the last 2 months has been pretty testing, but you can see this is a daily chart. Let's just put this on a weekly to get the back-to-back situation. So you can see a very, very sharp down week ending the 6th of September, and then it just immediately turned around and went straight back up again. So that has gone from looking somewhat shaky a week ago to looking extremely positive again. And we're only an absolute whisker of all-time highs. There's the NASDAQ on a weekly chart showing almost exactly the same thing. Now, we have got a lower peak, and that's because of the selling that's happened in semiconductors. But equally, this reversal is so emphatic that this may just prove now to be more of a consolidation zone. I'm still not of the view that the NASDAQ is just going to go straight back up again and form higher highs. But I think a zone of consolidation where we're just moving sideways in a band is probably the most likely outcome. Semiconductors did manage to turn up a little bit. If we put it on a weekly chart, you can see it's doing pretty much what the rest of the market had done. Semiconductors versus the S&P, we've got a downtrend. We're getting lower highs, lower lows. So the next week or two is fairly critical for semiconductors. Consumer discretionary versus consumer staples. Back here in 2021, the end of 2021, we got a very sharp reversal and cut down through the 200-day moving average. This is a bit of a different formation. We've just been going sideways for some time. This was a critical level, support level, and so far it's held. So this is probably the more critical chart to watch, the difference between consumer discretionary and consumer staples. Now, if we look at it on a sector basis, consumer discretionary had a very strong week, followed by staples, then materials, and then finance. So it's a very mixed bag. It's very hard to look at that, all those sector money flows, and decide whether the market mindset is really defensive or aggressive, because it's just a bit all over the place. In Australia, information technology stocks, a lot of it on the back of the strength in WiseTech Global, continues to lead the way, but banks have been pretty good as well. We did have a recovery in materials and small caps. Energy still lagging very much with oil under pressure. Okay, so that is the US market as it stands at the moment. The Aussie market, our dollar moved up a little on the weakness of the US dollar. And our market was up 1.1% across the week. And as happened in America, we pretty much reversed the prior week losses led by banks and IT. It was a good week for resources, but overall, energy and materials are struggling, and the trends are looking pretty poor. So they're just sectors where it's hard work at the moment. Turning now to precious metals, this was pretty good news. Gold was up by $92 to 25.79. So it's really moving very sharply now. Translated into Australian dollars, 38.47. So this is a new all-time high in Australian dollars. And silver also rebounded very sharply higher to 31.13. So all the precious metals charts are really looking extremely positive, and that's pretty much down to the fact that rate cuts are now becoming more the norm. We've got rate cuts in Europe. I think there was a rate cut in New Zealand, and the US almost certainly to cut rates during September. So that is certainly helping gold. If we look at the stocks themselves, in Australia, we had a monster week. XGD for Australian gold miners was up 7%, so that was a very strong week. We also saw a big surge in GDXJ on a global basis. And if you're looking at development stocks, so the producers have been getting the majority of the attention, which is pretty normal when a stock starts to go into a far more bullish phase. The money will flow into the producers first. And it takes a little bit of time for it to filter down the line to the developers. But if you're looking at developers, the key things is about the location and the strategic value of the resource, the funding that the company has access to, and probably most importantly is the people. More so in mining than in any other area, management with good track records just tend to keep getting the job done. So when you're looking at development stocks, they're the key things that you need to look at. Let's go and look at some charts now. So I'll start with silver. So you can see silver had a very nice 2-day rebound and looking very strong. It's still underperforming gold, and we need to get through this declining trend line here, which it's basically sitting on. So a break above there would be very positive for silver. There is gold in US dollars on a weekly basis. So you can see new all-time high. This is moving very, very sharply now to the upside. It was only the 1st of March when we were trading at just over $2,000. Now we're almost to $2,600 in the space of 6 months. So it's been a very strong move in gold. And that's gold in Australian dollars, the highest ever weekly close. Right, moving on to other commodities now. Copper recovered a little bit. I think it was about 402 or 403 last week, so recovered a little bit. Nickel didn't do much. Crude oil was up a little bit, but the trend is definitely down. The trend makes a pretty clear statement about the health of the Chinese economy and also the American economy as well. The demand is just not there. It's an area that is certainly under pressure, and no more so than in Australia, where energy policy is just such a mess. If we look at lithium, there was some news that got the bulls excited during the week. The world's largest Chinese battery manufacturer, CATL, finally moved and cut production at a couple of their mines. That was taken as a big signal to the market that we might be getting back into or back towards some sort of equilibrium between supply and demand. And it raises the question, though, that we got very sharp percentage rises in the miners like Pilbara Mines, Mineral Resources, etc. Is this just a dead cat bounce in the miners? I think at this stage you'd have to say probably yes. It's hard to see that anything has really changed sufficiently in the lithium market, so it's still a market to be very, very careful about. I certainly wouldn't be trying to go in heavily to try and pick the bottom in lithium. I have no confidence that that's where we're at. Other commodities and uranium, we had an announcement out of Russia that they might curtail the export of uranium and nickel. Is this Putin bluffing on export restrictions? Hard to know. Uranium has certainly been a sector that's also struggled in the last couple of months, so nothing really that clearer there. And there's the crude oil chart. So you can see there's a clear downtrend since April. We're up around 87, 88, and now we're down in the mid to high 60s. Wrapping it all up, forming a picture of what your portfolio should look like is something that I get quizzical responses from various people, but it's something that you can do. It's something that's incredibly valuable because it just makes the building of the portfolio so much easier and so much clearer. And I just pose the question, why not? Why not sit down and think about what you want the composition of your portfolio to look like? And that's a balance between large caps, small caps, resource stocks, non-resource stocks, high volatility, low volatility. You can sit down and just think it through and make some decisions about what is the sort of portfolio that would give you the returns that you're looking for with a level of volatility that you find acceptable. Now, I get it that most people don't really know where to start because you don't know what the potential stocks you could buy are and what their volatility is. But it's just organisation and then patience, because sometimes you've got to wait 6 to 12 months to have a good entry price into the stock that you're waiting on. But it can all be done. But if you don't know how to do it, then that's fine. And that's the position that most people are in because they're just not close enough to the market to know how to do it. So that's fine. But get help with it. I mean, how many things in life do you call in an expert to get assistance with? This is probably the most important thing in your entire life that you should get assistance with, and that's building your wealth for the future. All right, that's the main messaging for this week. Portfolio analysts last week, we looked at, was the character of the market changing? And we certainly got a pretty definite answer to that by the close of the week. We also looked at my favoured silver stocks as well. Silver's been extremely difficult over the last 5 years to make any headway with actual silver developers or silver producers, but there certainly are a couple are doing extremely well, putting runs on the board. That's it for this week. More information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.